Good morning, everybody. November 25th, 2024. I'm Herb Morgan, Senior Managing Director, Chief Investment Officer here at Cantor Fitzgerald Managed ETF Portfolios. This is my weekly economic and market commentary. As a reminder, if I have something to say intra-week, I'll put it either on LinkedIn, you can follow me there, Herb Morgan, or also on X, you can follow me there at Herb W. Morgan. Presentation has been prepared by me and Cantor Fitzgerald Investment Advisors for use with you, whether you are a financial advisor yourself or an individual investor. Either way, you're expected to make your own investment decisions. Nothing in the presentation is investment advice, tax advice, or recommendation for the purchase or sale or hold of any securities. It is strictly for informational purposes only. The views expressed herein are mine and mine alone, may differ from the views of CFIA's parent, affiliates, or other portfolio managers at CFIA. Well, the bull market in equities just continues. The higher the market goes, the higher the risk is for investors, unless the earnings go up faster than the market's going up. But we're going to get back to that in a minute. But we're seeing this continued broadening out theme. Look at small and mid-cap stocks. Mid-cap up 4.2% on the week, small cap up almost 4% on the week. International markets didn't really participate in the developed side, but emerging markets up about 20 basis points. Interest rates, which the 10-year has gone up considerably since the Fed started cutting rates in September, seems to have that sort of sell-off in bonds seems to have settled down. We got up to about 4.5% on the 10-year Treasury. It's now down to about 4.40. Still, the aggregate bond index gained about 20 basis points on the week. High yield, though, on signs of a strong economy, and we call high yield sometimes, I call it mid-cap with a coupon. It has a lot of performance characteristics that are similar to mid and small cap equities, up about 40 basis points. On an interesting side note, corporate bond spreads have really tightened in the last few weeks since the election. They were tight before that, and they're nearing historical levels, where you sort of look at that and say, well, does it make a lot of sense to be aggressive with corporates to make that little extra spread if the spread is very, very tiny and you're taking risk every time you own corporate paper, you're taking credit risk, of course. Last week's economic data was by and large very good. November National Association of Home Builder housing sentiment rose to 46, getting closer to that line of delineation between optimism and pessimism for the nation's home builders. You can see that's 3 straight months in a row. Now we're still below 50, so it's not like it's ebullient or the housing market's doing great, but it is trending in the right direction. And perhaps if rates do come down for mortgages, we'll see that number get back above 50. When asked, present sales component was looking a little better, but their view on future sales got up to 64. So even though things aren't good in the housing industry, the home builders are saying we're pretty optimistic about the future. Existing home sales continue at a very low level, but spiked a little bit higher. You can see last month they were up 3.4% after a decline of a little more than 1% in September. That was a little bit of a dip in mortgage rates after that initial rate cut. But you can see existing home sales in the 6.5 million range back when interest rates were essentially zero. We have a long way to go. Annualized pace is below 4 million. The nation's home builders also are not starting as many homes and they're not pulling as many permits. As you can see here, housing starts fell 3.1%. That was double the expected rate in October. Building permits declined about 0.6%, and the estimate was for an increase of 0.7%. We continue to have great news in the labor market. Weekly claims for unemployment fell to 213,000. That's really, really close to the cycle low. You got to go back decades. You can see just bumping along the 200,000 line there. Continuing claims rose to 1.9, but that likely reflects some secondary effects from the Boeing strike that happened, and that was really all out of the state of Washington. So that little tick up from 187 to 190 is not worrisome to us at all. We got flash PMI readings, manufacturing and services, but we also got a regional PMI reading for November. The November Philly Fed survey fell to minus 5.5. The estimate was a positive 8, so that was very disappointing. But new orders fell, but were positive. Shipments fell, but positive. employment actually turned positive, and the outlook, the future outlook, jumped significantly from 37 to 57, and that might have something to do with this survey was taken after the election, and perhaps there's some ebullience. We've seen it in the stock market. It sort of drove things a little bit higher. In terms of the flash readings for the month of November, which I know isn't over yet, we will get a final reading either later this week. Actually, it'll be next week. I take that back. The S&P Global Manufacturing still below 50, but you can see creeping higher towards that line of delineation towards expansion. Rose to 48.8. It was just right in line with the 48.9 estimate. Keep in mind, manufacturing, about 15% of the U.S. economy. Services, about 85%. And you've been hearing me say that the economy has been reaccelerating. It's one of the reasons I think the Fed is between a rock and a hard place here, right? They thought the interest rate was prohibitive. They've cut it now twice, really 3 cuts, two meetings. But economic activity continues quite strong. The services PMI got to 57, and 57 was above the estimate of 55. You can see it over here on the right. We haven't been at this level since early 2022. So it's a very, very strong reading. No sign of recession or slowdown at the moment. But consumers don't feel particularly good, so the sentiment is still low. I think it has mostly to do with prices. They have come down in terms of the rate of increase has come down. Prices themselves have not. Consumer sentiment rose a little bit, but still remains well below the pre-COVID sentiment levels of about 100. So well below that pre-COVID level of 100. The other thing that's happening, and this is a Citi Economic Surprise Index. So what they do with it is they say, okay, all the economic data that comes out this week, if the data is better than the consensus estimate of the economists that report into Bloomberg, then it's positive and it goes above zero. If the data is fails to meet the expectations, it's negative and goes below zero. And as you can see, really since October 1, we've gone above zero and just trended significantly higher. The economic data since October 1 has been well above expectations. So again, more to say there's really no recession coming. Is there really this need for this focus on cutting interest rates? I realize the rate was high, but it had to be to curtail some of the inflationary pressures that still exist in the economy, the most significant of which is the massive fiscal deficit, the deficit spending. I'm going to go back to the equity markets for a minute. I've showed you this the last couple of weeks, but it's so important. I want to make sure everybody catches it. This green line at 440 is the yield on the U.S. 10-year Treasury. We got almost to 250 intraday, intra-week last week. Almost got to 450. The pink line represents the earnings yield of the S&P 500 at 3.75%. That's a very large gap. Remember, 440 is risk-free. You get it for 10 years. You don't take a bit of risk. If you're owning equities now, the earnings yield is 370. So if you're buying equities now, you've got to assume that either the estimates for earnings are wrong and they're going to be much higher than expected. That certainly could be the case. You have to expect that. Or interest rates are just too high and they're going to come down very, very significantly. Or you're going to have continued multiple expansion in equities, driving prices even higher and PEs even higher. I find that hard to stomach. So I want to encourage everyone to make sure you're comfortable with the equities for the long term, because I do think the next 6 to 12 months could be a little bit rocky. In terms of economic data, there's plenty this week with a shortened holiday week, obviously shortened for the Thanksgiving holiday. We've got house prices from FHFA and Case-Shiller and new home sales tomorrow, Tuesday, consumer confidence, Fed minutes from the last meeting, the November meeting. Third quarter GDP expected to be right in line with the prior report, the preliminary report. Durable goods, weekly jobless claims 217. That's a great number. Chicago PMI to go along with the Philly. Manufacturing gauge below 50, unfortunately. Income and spending both look very strong, but the number to watch, the big number for the week, will be on Wednesday. PCE, core PCE prices. This is the measure the Fed gives to determine whether or not they're meeting their inflation mandate. Expected to be up 0.2%. If it's up more than that, that's not good news. If it's down more than that, that's excellent news. Thursday, the markets are closed for Thanksgiving. Friday, the markets are open, but no economic data. Thanks, everybody, for tuning in. See you again in 1 week.